Well, investors are poring over lots of earnings, including earnings right here in Canada, deciding whether to take profit or add to undervalued positions. Let's get the views of Julian Emanuel on the markets. Julian Emanuel is Senior Managing Director at Evercore ISI. He joins us from New York. Let's begin, Julian. First of all, thank you for joining us. Let's begin on these NVIDIA numbers. It's a bit of a investors have had different ways of looking at this ever since the results were issued after the close of trading yesterday. The earnings per share were better than expected. The sales in the quarter were better than expected. Guidance is seen as a bit soft, particularly on the question of gross margins.
So if you look back at the last couple of years worth of quarters, shares have had varying reactions right in the wake of the earnings release, depending on whether the results were great or absolutely spectacular. And not every time when you got the absolutely spectacular results did the share price respond positively. So we don't want to do here is conflate the near-term noise, and particularly in that name, there's been a lot of near-term noise. Frankly, you had a very good rally off the DeepSeek shock, which ultimately we think will continue to drive AI adoption forward in the months and years to come. And we're seeing that in terms of corporate commentary. But so the big picture, again, is, and this is one of these times, and frankly, the talk around tariffs is another one of these noise-creating events that we don't want investors to lose sight of the fact that both on the individual level with regard to AI and at the S&P 500 level, earnings growth is likely to be strong enough to support further gains in the months ahead.
Okay. Is the artificial intelligence story beginning to mature? We don't want to put too much emphasis on one set of results from one company, albeit it is the perceived flagship in the sector. But we didn't see NVIDIA crush expectations as it did in the past. It's somewhat cautious on gross margins. Are expectations catching up to this sector, and is reality beginning to set in perhaps on things like gross margins?
So if you had thought about this in the context of, let's say the internet boom of the late 90s and the early 00s, this kind of report would have been almost cataclysmic for that type of name. But the fact is that when you look at the longer term action, the market has been going sideways in this name for the last 7 or 8 months, as reality has caught up to hype and expectation. And now we're at a point where you're digesting this new raft of news around developments that is likely to, A, make technology cheaper and more accessible, and B, ultimately spur demand. So, from our point of view, the reaction to the report, particularly since you had this run off of the DeepSeek trough, is actually a glass half full kind of interpretation, because it could be far worse than it actually is.
Two big Canadian banks, at least two big Canadian banks this morning, cautioned their shareholders and anybody reading their results that the threat of U.S. tariffs towards Canada is a very material risk to the Canadian economy. I would not be surprised if they thought it was a risk to the North American economy. Many of them operate in the United States, and one of them is a big operator in Mexico. What is your view on this tariff conversation and the implications for stock markets in North America?
Look, we make no bones about it. Our internal work says that if you got tariffs on the order of what's proposed, 25% blanket tariffs on Canada and Mexico, and obviously the ratcheting higher in China, and the potential for EU tariffs to hit at mid-month in steel and autos and so forth, you are talking about, in the U.S., of a drag to the economy of at least 0.4 of a point of GDP, likely higher if there was full implementation. Our policy people don't believe that you're going to get full implementation. And I think we've seen this with President Trump, that nothing is set in stone until it's actually set in stone. And if you go back to yesterday's cabinet meeting, it wasn't exactly certain whether we were going to get the the rhetoric today is we will get something announced on March the 4th. But, in the Trump administration, there's still a number of days between now and March the 4th for negotiations to press forward.
Okay. I believe, if I understand your notes correctly, you see some near-term downside potential in the S&P 500, but you're pretty bullish on the full year. You think I'm reading that you believe stocks, as measured by the S&P 500, remain on track for a 6,800 point finish by the end of the year. That's 13% upside from here.
That's right. So look, this is one of these times where if you think again about the uncertainty around tariffs, the year 2018 comes to mind very quickly, where you had sort of 3 steps forward, 2 steps back, volatility, much the way as you're having now, especially since the election. But ultimately, the progress goes further. And from our mind, when you think about what ends bull markets, it is an economic turndown. We do not see a recession, even if growth does slow. The Fed being uncooperative, the Fed is not going to hike rates under any circumstance in 2025, in our opinion. The bond market governing otherwise, vis-a-vis yields moving towards 5%. Obviously, the last several weeks tell us that, if anything, growth is the primary concern. And then the last one being excessive speculation. Every stock market cycle has excessive speculation prior to its termination. We haven't seen that yet. We think an environment of greater deregulation and more capital markets activity is still ahead. And putting that all together, earnings growth of near 10% in our mind gets us to 6,800.
Julian, thank you so much for this conversation.